seen a battle between the central banks and the collapse of the financial system fought on two fronts. One front, central banks preside over the creation of additional liquidity for the financial system in order to hold back the tide of debt defaults. On the other, metals, soft commodities or anything else might be deemed an indicator of inherent on the other, so they incite investment banks and other willing parties to bet against the rise in the prices of gold, oil, base metals, etc. Their objective is to deprive the independent observer of any reliable benchmark against which to measure the eroding value, not only of the US dollar, but of all fiat currencies. Do you agree or disagree on that?
I think you could look at the way the banking system is constructed and you can come to that conclusion. I don't myself perceive that there is a deliberate attempt to try and deprive the market of any benchmark. I think that is just a consequence of the times in which we live. Yes, there used to be a benchmark in the form of gold. That's been taken away in explicit terms. It doesn't mean to say that gold doesn't still represent as an investment opportunity what it used to in days gone by, but what it means is that gold fluctuates. There's no benchmark against which gold is set. So yes, it's like the analogy is like a ship on the sea without an anchor, I suppose. I don't know if that's an inherently more unstable situation than having an anchor. Maybe a sailor would say it was, but for quite a lot of your history or your experience, you're naturally sailing without the use of an anchor anyway. So might it be important at some stage in the future that you don't have an anchor? Yes, you can think of you can construct a set of circumstances in your head where not having that benchmark is a serious flaw and a failure in the system, but for most of our lives, most of the time, it probably doesn't matter as long as the rest of the ship of state, in my analogy, does continue to sail safely on.
In recent years, have central banks or governments been trading in the gold market and related markets?
Well, there's certainly been central banks that have been buyers of gold, yes, and across the period 2007 to present, the central banks as a block went from being net sellers of gold to net buyers, I think for the first time since the 1970s, so yes, very definitely.
Do you think that is that to make money or to obtain more gold or to try and get a handle, a control over the gold price?
No, I would see it as asset diversification, in particular asset diversification away from the US dollar. And at the time then they were buyers of gold, it was simply because the US dollar as the world's reserve currency is the currency or the US denominated assets which are held in the reserves of central banks, of overseas central banks. Now that usually means treasury bonds. If you're holding treasury bonds at a time when yields are, for the sake of argument, 0.5% and inflation is 2%, then you're guaranteed to lose money by holding that bond. So it makes sense to diversify into real assets, and one of the few real assets that a central bank can genuinely diversify into. And what do they want? They want dollar-denominated real assets. Well, one of the very few assets they can diversify into is gold, so that's what they were doing. So I don't think it's a conspiracy. I know some people regard it often as when central banks are buying or selling, they regard it as a conspiracy. I would see it just in the normal course of, in that case, you'd see it in the normal course of reserve management and reserve diversification away from financial US denominated assets.
Given the size of the gross stock of global debt instruments at 90 trillion, which is an unimaginable amount of money, but how much
do you not have 90 trillion in your... Now, I wish I had I don't have my note I can show you. I have a 100 trillion Zimbabwean dollar note. Yes. And all I'd have to do is just take that note out and pay it over, and there you are. There's the world's debt problem solved, but sadly no.
Oh, wow. Well, given the size of this amount, how much capital will it take to control the combined gold, oil and commodity markets?
I don't know. I once did a calculation. I suppose I could try and do it again. Let's say the world produces 5,000 tons of gold every year. That's 5 million kilograms, which is 150 million ounces, which is 150 plus a little bit, plus another 13, $180 billion. So that's the gold, the global gold market in 1 year is $180 billion, give or take. So the point is, it's absolutely tiny relative to the sorts of, when we talk about the stock of debt or the stock of equity or funds under management, it's absolutely tiny. That's one of the reasons for the potential upside, I think, in the gold price is you would only need to diversify a tiny amount of the world's financial assets into gold to completely overwhelm the physical gold market and therefore, by extension, presumably, push the price higher. Now, oil, I'm not an oil analyst, so I don't know. I'm pretty sure the oil market is bigger, but I'm pretty sure that it would, even if it's one order of magnitude larger than the gold market, it would still be tiny relative to the stock of financial assets held globally. So do you think that
sort of given that relatively low price,
relatively low value.
Does that mean that all is well in global economies and that we live in a safe world?
Oh no, I don't know. I don't think that translates as we live in a stable world and all is well at all. No. Even this week or last week, the Economist was talking about the amount of debt in the global economy and talking about it, and I think correctly, as the great distortion, and the fact that interest payments can be offset against tax, and how all of this and a lot of legislation also has diverted funds, in particular into the housing market, short-term politically very popular, but actually it's depriving the world of investment into productive assets, and it's making houses unaffordable for some people in the countries in which they live, which of course is precisely the reverse of what most government policy is, which is to get everyone who wants to buy a house into a house. So no, the stock of debt I think is very high. I think the incentives towards taking on debt are misaligned, and I think also there is a misalignment in terms of how much is allocated towards secured real estate lending versus how much is allocated towards productive assets. And this is quite different from the situation 100, 150 years ago, where the vast majority of debt was directed towards productive assets and not towards real estate. And to a large extent, what we seem to have done is turned the world into a large property fund, which seems, to my observation, a slightly strange way of running a regiment.